where we are, we have 4 questions that came in via email. One of them, I am going to be honest with you. I'm going to struggle through it, but I always promise that I answer every question. But I'm going to struggle through this a little bit. And of course, you're all encouraged to help me with this as well. And then 3 other questions that we're going to look at related to using the power option tools to roll positions and to find positions and general strategy adjustments as well. So let us begin with our questions via email. Number 1, first question comes in from Bob. And Bob says he's quite clear on delta, how it works, how it can be adjusted. However, the recent market activity is telling me that I need to better understand gamma. I know its definition and what it tells about delta, but I need a better practical understanding of how it works into an option strategy, when it should be adjusted, how it should be, and can be best adjusted when necessary. Okay, so I'm going to pause here. We're going to come back to the slides for the questions, but I'm going to pause here. We're going to navigate over to the Power Option suite of tools, and we're going to walk through a little bit of the Greeks, but most importantly, on the gamma to answer Bob's question, okay? Now, this might be a little bit of an advanced concept, and you guys see other questions coming in, and it's a great question that came in related to the radioactive trading techniques from Ben, and I'm going to get to that after our email questions. So what we're talking about here is the Greeks. And let's just I'm going to take a basic option. Let me go to the portfolio. I'm just going to pick a basic option that's going to come up from one of our other examples. I'm going to take, this is for a Kokan's question later. I'm going to take the short put, the 155 put on CRM, and I'm going to go to research. I'm going to put research, of course. The research tool gives you the entire view of what's going on with the option. The screenshot right now of the option as far as things such as the prices, of course, last trade time, session close, and more. Returns, range out of the money, and all of your Greeks over here on the right. We've got our delta, of course, which is what? Well, it's the expected move of the option price for a 1-point movement in the stock. So we know here we're looking at the 155 put, remember, that expires on March 20th, 14 days away. And the stock's about 164, so this delta right now is at 0.25. A negative 0.25 because it's put, meaning what? If the stock falls 1 point, we should expect our option premium here at about 275, 315 midpoint to go up by 25 cents because we sold this put. If we had bought the put and the stock moves up plus 1 point, we'd expect the premium to decline by the amount of delta, to drop down 25 cents. Call, of course, stock moves up 1 point, our delta is positive, we should gain the delta on the call. And if we sold the call as a covered call, the stock moves up 1 point, our option premium should increase by the delta. Okay, now, gamma. Gamma is essentially the relation, it's the delta of the delta, lack of a better term. What this is telling us is that if the stock moves up 1 point, we would expect this put delta or the put premium, excuse me, to drop by 25 cents. And then we'd expect the new delta to come down to about 0.23 or 0.229 roughly, because it's going to change by a rate of 0.021. Why is all of this important? The movement of how the delta reacts to the stock movement and how the gamma changes with the delta movement, which it changes the delta movement, I should say, but how the delta and the gamma change as well. Well, for anyone who's doing covered calls, maybe cash secured naked puts, maybe even bull put credit spreads, to me, this is not necessarily that important. But for Bob, it is important. And the reason why is that Bob's doing a specific structure on underlying securities. What Bob is looking to do is essentially trade double diagonals on, say, something like SPY or IWM, something far out in time, or even standard stock securities, where he owns far out options. I shouldn't have chose SPY for this example, but I did. So give me 1 second. And Bob has some far out in time options. I'm going to go ahead and use December 18th cycle here. Okay, so I'm in December 18th, and we're just going to say, let's say right now I bought a 311, or I'm going to buy a 310 call and 286 put, roughly. Okay, and then nearer term in, we're going to sell 2 options against it. This might not be his exact structure, but that's okay. We're going to talk about, we're going to look at the structure of double diagonals. All right, let me go 305. This is kind of probably too close here, and 290. These are probably a little bit too close for our situation, but again, let's just build the spread and look at it. And I'll explain the ranges that we're talking about. Okay, so what do we have here? We're buying a 311 call. Oh, no, I'm sorry. I want to keep the numbers simple. Buying a 310 call and a 286 put out to December, selling near term, closer to at the money against it. We'll just use 1 contract apiece to simulate the double diagonal position. I don't even know if this is a good double diagonal. I just grabbed numbers, as you can tell. Well, looks pretty good right now as far as the profit and loss chart goes. The break even at the near term is going to be very far away. But again, we're only at 306 and 290. A comment does come in, you're too close on your strike prices. Yeah, this is just an example. I probably should have done something further out, I agree, in that case. All right? Okay, so when I traded, I'm not going to go too in-depth in this. As I mentioned, I'm going to plod through it because I'll answer any question that comes in. But when I used to do standard diagonal spreads, like a covered call, what some people call the poor man's covered call, that gives you this sort of sloped profit and loss chart. And this looks like an iron condor, but with sort of this bow in here that isn't as exaggerated, and then it would come out such as this because of the time factor between the two. What was really important to me was the delta ratio when I entered this position. I wanted the delta of my long to be around 0.7, 0.8, and the delta of my short to be out of the money, you know, around 0.3 or 0.4. I was looking for a delta ratio of about 1.6 or greater, meaning the delta of the option that I'm buying is about 6%, 0.6% higher than the delta that I'm selling. All right, so if I have a delta of 0.8 and my short option delta is 0.3, if the stock moves up 1 point on a diagonal call spread only, directional, I'd expect, again, 80 cents on the long while only losing 30 cents on the short. Double diagonals like an iron condor, where I want the stock to stay in between here, but a prominent discussion of management for this strategy to avoid large leverage losses and wild market swings is to remain delta neutral. So in both cases here, the delta on my short call might be positive 0.03. I'm sorry, the delta here is 0.3. I'm sorry. Let's clear that out. Start over. Delta on my short call that we sold here is about 0.3, and the delta on my long that we bought here at 310 might be at 0.6, let's say, 0.7, probably 0.6. But remember, I sold this, so this is a negative delta. So just on this calendar call, out of the money calendar call, I have a positive delta of 0.3. This is sold, so it's negative. This is bought, so it's positive. So combined, I have a positive delta of 0.3. We bought the put down here, which has a delta of negative 0.6, meaning if the stock moves up 1 point, we might expect to lose 60 cents or so on that far out put option. And my short option delta here, out of the money a little bit, again, might be at negative 0.3 because, of course, it is a put option. But I sold it, so this becomes a positive. So on this side, I have a delta ratio between these two of negative 0.3. I open this position at delta neutral. And the idea is, as the stock moves up, what's happening? This delta is increasing, this delta is increasing, this delta is decreasing, this delta is decreasing. So I might make a management to try to keep delta neutral as the stock fluctuates up or fluctuates down. But what do all 4 of these options have in addition to delta? They all have gamma. And so the underlying concept is that if my delta, this is very complex, and if I'm losing anyone here, some of you new investors, a couple of questions came in, hey, I'm new to power options. Don't log off yet. We're going to get to all your questions, and we're going to get to the basics right away. This is a more complex thing. I just always promise I'm going to answer every question. But as we saw, if the delta of this near-term short is 0.02, meaning that for a 1-point movement up in the stock price, I'd expect this short put to change by 0.02. And this one here is 0.05. And on this side, I'm 0.05 when I open the position, and here I'm 0.02. So I'm also gamma neutral with all the pluses and minuses that come in. And the other idea in this case is that if the stock swings up or down, I know my delta is going to increase on my call sides, which means the gamma is going to start increasing as well, especially as you get closer to expiration. What happens at expiration? The delta of your call options or your put options are going directly to 1 or 0 based on if they're in the money or out of the money. Your gamma is also going to be increasing in that direction as well. It's either going to be going to 0 if it's out of the money because a change isn't going to likely affect it 2 days, 1 day before expiration, and it's going to be higher if it's in the money. So the concept is that in addition to changing the position to be delta neutral, does Bob have to start paying attention to the gammas to start being gamma neutral as well? This is a hard thing for me to answer. The reason why is because I never really did double diagonals. I'm going to be upfront with that. Not a strong strategy of mine. I see the benefits of it. I actually see the benefits of the double diagonal over a standard iron condor with short-term expiration. This gives you more time to manage, adjust, and roll because the legs are further out. You've already paid it. It is done at a debit, though, where the iron condor, which just has your similar profit plateau without sort of the skew of a double diagonal. It's a sort of Batman profit and loss chart. But when I was doing the standard diagonals, what some of you might call a poor man's covered call, buying an in-the-money leap and selling an at-the-money or out-of-the-money near-term call against it, which I still do in my portfolio but haven't done in a few months, probably 6 months to be honest. Well, I did 3 positions 3 months ago. I haven't done anything in the last 2 months. But in any case, building my strategy, building my trading plan for this directional trade only, I did pay attention to delta. I didn't fight to be delta neutral as long as I was still in the profit range that I wanted. If I was in the profit range that I wanted, I'd typically close the spread in the first 2 or 3 cycles rather than trying to fight to keep it delta neutral. Did I miss out on money by not trying to keep it delta neutral as I continued on? I'm not sure. I hit my targets and I was happy with that. So now we come to the point of gamma and getting to the idea of gamma, which is shifting rapidly. And I never saw with the one directional trade, to me personally, that trying to keep gamma neutral or adjust by gamma was more beneficial than the stops or the trades that I was already making. The stops that I had on the position, the triggers I would use for rolling the short leg or rolling the whole spread up or down if it was going against me. I never really saw the gamma concept work in my favor to any benefit that was greater than what I was already doing. But that was directional, not neutral. So my direct answer to Bob in this case is that I think the gamma should be paid attention to for this strategy. But I also think in this market of the last 12 to 14 days or so, you're running into a massive problem. And the problem, of course, is that when we see giant dips like we have at the opening on a certain day, let's just go back to Monday on SPY. Let's select our date. We'll go to March. So we're going to go with a little bit historic here. We're going to go back to March 2nd. Okay. And I just want to look at puts for this time being. Okay. Now we were up a good 4%. Everything was looking rosy. I'm going to take a straight delta. What am I, small chain? Okay. Let me, go here. Let me go to the 16th. 14 days out in time from Monday, March 2nd, looking at the 16th of March expiration cycle. And I'm going to go to a delta of what we were talking about, 0.3. And that's going to be the 301 strike, which is roughly around $6. Okay? So we have a delta of 0.3. I thought I added it. Hold on one second. I'm going to go into the add remove column section, and I'm going to go ahead and let me reorder the columns. Hold on, I'm going into a different window here. All right. Okay. All right. I know you're not seeing that right now. That's perfectly fine. There we go. All right. So here we are. Good update, 4%. Pressure is easing. Volatility has dropped, but not as much as I thought it would. I think we were still around 33 on the VIX on this day. I think we ended around 39 today. But in any case, we were talking about our 301 strike, delta of 0.3, and what do we expect again? Gamma, 0.02. Okay? And this is our put option. Okay, so what does that mean? We have a negative delta, so if the stock moves down 1 point, we're at about, let's call it $6. It says 605 midpoint, so we'll call it 605 midpoint. And let's just move to the next day. That's our 301 strike. And we're down about 3%. Okay, not bad. 301 strike, March 16th. All right, so our midpoint, I'm sorry, you can see it there. It's about $8.75. SPY fell $8.85. We're at $8.75, so $2.70 above where we started. And that makes sense, doesn't it? Why? Dropped 885, had a delta of 0.3 at the time. And we increased by 275 for almost a 9-point drop. That's pretty close to a 0.3 delta, isn't it? $2.70, right on it. Gamma didn't change too much. It's very small. But again, for a 1-point movement in the stock, the delta went from 0.3 to 0.48. We saw almost a 9-point drop, let's call it there, and our delta was 0.02. So it moved from 0.3 to 0.48, 18 points. That's almost dead on. Now, next day. Where I'm going with this is that what you tend to see, now we're back up 1262, we're doing good, a little bit of easing. Where's our 301 strike? Back to 360, 365. Delta drops back to 0.21, so we lost a delta 0.17, okay? And again, because it moved up 12 points, we were at 0.02, 24, movement of the delta, it's pretty close. And now we're down to 0.0188, we're lower. Now, next day, and this is where I'm going to stop on this discussion with a little bit more. I saw that Bob had commented in a moment ago with a comment. He just said, hey, Mike, I think you wanted to say something, Bob, but you didn't. I didn't see the rest of that yet. All right, now we're back to 855 again with the movement down, back to 0.46, and the gamma has not yet reached 0.2, but it's climbing back up to it. Meanwhile, the long option is changing. That's far out in time. Meanwhile, the two short options are changing, but the change is so minimal with the short options and the long options. That's why I never saw the benefit of it, of trying to keep gamma neutral. And with wild slings like we've been seeing, here's where we're back down 3.32, and then go to today, of course, down another 5 points, 165. It's much worse at the beginning of the day, I believe. In any case, one thing with this gamma that might drive you nuts is that you set up the position to be gamma neutral from the beginning. And it's such small changes in the gamma number that when the market is going through these kind of conditions, Bob, my fear is you're going to be over-managing this structure because you're going to be trying to get into a gamma neutral position consistently and you're going to be fighting between movements of, 0.0015, 0.0025, 0.0045 on your short-term options, with only a change of maybe 0.002, 0.001 on the farther out options that aren't reacting as quickly. I think it leads to over-management. I think it's a good thing to pay attention to. My fear is that when you're watching your positions, you were watching the market this week, you were worried that you need to pay more attention to it because you were seeing losses. The truth is, I think that even if you were paying attention to the gamma and trying to remain gamma neutral with these wild swings, your double diagonals would also be hurting, and you'd also be hitting your trigger points on a consistent basis. And it'd still be a losing position. Even if you went to gamma neutral, you'd just be keeping adjusting, and then adjusting back, and then adjusting back. And I think it would be a result of overtrading. I'm going to attempt to do more advanced analysis for you on that and go through an SPY example with the numbers I sort of put together. So we can see a little bit better if we are missing something or if we're not. All right, and Bob just commented, he says, Mike, thanks for the discussion. This has been a helpful guide to me on what I should be thinking about relative to gamma. And I occasionally am a victim myself of overmanagement. Good counsel. You are now free to exit the rabbit hole. My initial email response to him was that I'll go down the rabbit hole here and we'll take a look at it, but I'm going to stumble through it.